Getting a mortgage can feel like you're trying to navigate this huge, complicated maze. But what if I told you there's a map, a rule book, really, that protects you every single step of the way? Today, we're going to walk through the key federal laws that guide your journey and hopefully turn that maze into a clear path from the very first ad you see to the moment you get the keys.
Oh, you've seen them, right? An interest rate that looks impossibly low, or a flashy promise of instant approval. It's so tempting, but that little voice in your head starts whispering, what's the catch here?
Well, the thing is, there often is a catch. But here's the good news. There are some seriously powerful laws out there made to protect you. So, let's follow that legal path together, step by step, and see exactly how these rules work for you in the real world.
All right, so our journey starts where most people's do, with an ad. This is that first impression, that first point of contact, and believe me, it is heavily regulated to make sure you're not being misled right from the get-go.
Okay, so the first rule in our playbook is something called Regulation N, or the MAP rule. Just think of it as the truth in advertising law, but specifically for mortgages. Its whole job, its entire purpose, is to stop lenders from making any claims that are deceptive or misleading about, the costs, the terms, the real deal of a loan.
So what does that actually look like? How does it work in the real world? Well, under a law called the Truth in Lending Act, TILA for short, if an ad uses what's called a triggering term, like say a specific monthly payment or a super low down payment, that legally triggers the need for way more information. So when you see an ad screaming only 3% down, the law says they also have to tell you the full annual percentage rate, the APR, and they have to warn you if your payments could go up later on. It's all about forcing transparency.
And this isn't just a suggestion. There's real accountability baked into these rules. Lenders have to keep copies of everything. We're talking TV scripts, social media posts, you name it, for at least 2 years. What that means is, if there's ever a fight about what they promised, there's a paper trail. It just goes to show you, these laws have some serious teeth.
Okay, so you've seen an ad, you found an offer that looks good, and you're ready to apply. The next step? Proving who you are. And this part, it's not just a bunch of paperwork for the lender. It's actually a really big deal for national security. And that brings us to the USA PATRIOT Act. Now, I know it's a huge national security law, but a key piece of it directly affects your mortgage application. It basically requires all financial institutions to have a formal process to verify who their customers are. And it's all about stopping financial crimes. That process has a name, the Customer Identification Program, or CIP for short. And it's really just a simple 4-step process. First, they collect your basic info, name, address, all that. Second, they check it against documents, like your driver's license. Third, they have to hang on to those records for 5 years. And finally, they check your name against government watch lists. It's a standard security check that everyone goes through. All right, fast forward. You've been approved. Now it's time to make it official. And, in this day and age, that usually means signing a mountain of documents electronically. But how do you really know that a digital signature is legally binding? And more importantly, that it's secure?
Well, the most important idea is captured perfectly in this quote from the eSign Act. Basically, you can't accidentally agree to sign these huge legal documents online. The law makes it so you have to take a clear, deliberate action, they call it affirmative consent, to prove that you're totally on board with handling the whole process digitally.
So here's the breakdown of how that actually works. Step 1, the lender has to lay out all your rights, like the fact that you can still get paper copies if you want. Step 2, you have to actively give your consent. No pre-checked boxes allowed, you have to do it yourself. And step 3, you have to do a little test, like opening a sample file, just to prove your computer can actually handle the documents.
Okay, so we're at the closing table, or, the virtual closing table, and another really important protection comes into play, especially if you put down a smaller down payment. This is the Homeowners Protection Act, the HPA. You might also hear it called the PMI Cancellation Act, and its whole job is to stop you from paying for private mortgage insurance, that's PMI, for 1 day longer than you absolutely have to.
And here is the number you need to remember, the one that can literally save you hundreds, maybe thousands of dollars, 78%. That's your loan-to-value ratio, or LTV. Once your loan balance is scheduled to hit 78% of your home's original price, your lender is legally required to automatically stop your PMI payments. Now, you can often ask them to cancel it earlier, at 80%, but that 78% mark, that's your automatic safety net. It makes sure you don't overpay.
So, we've talked about all these rules, but who's actually making them, and who's enforcing them?
Let's zoom out for a second from our personal journey and meet the referees, the federal agencies that oversee the whole mortgage industry.
You know, a huge shift happened after the 2008 financial crisis. Congress passed this massive law called the Dodd-Frank Act, and out of it came a brand new watchdog with one single mission: protecting people like you and me in the financial world. And that agency is the Consumer Financial Protection Bureau, the CFPB. This table does a great job of showing you the two main players side by side. You've got the CFPB. They're the ones writing and enforcing most of the rules we've been talking about. They're behind those big mortgage disclosure forms, the TRID forms. Then you have the Department of Housing and Urban Development, or HUD. They focus more on the big picture, like access to housing, fighting discrimination, and overseeing programs like FHA loans.
And here's one more really practical protection for you. When you apply for a mortgage, your lender's required by law to give you a list of at least 10 HUD-approved housing counseling agencies. This is huge because it guarantees you know where to find impartial expert advice if you ever feel like you need it.
Wow, okay, we have covered a ton of ground, from the very first ad you see to the agencies that have your back. So let's pull all of this together into a simple toolkit of rights that you can take with you on your own mortgage journey.
All right, let's wrap this up. Here's your toolkit. The biggest thing to remember is that you are not going into this process alone. You have the right to ads that tell the truth. You have the right to a secure process when you give them your information. You have the right to be in control of signing things electronically. You have the right to get rid of PMI when you've earned it. And you have the right to file a complaint with a federal watchdog like the CFPB if something feels wrong. These aren't just nice ideas. They are your legal rights. At the end of the day, knowledge really is your best tool for any financial journey. Because when you understand the rulebook, you can spot the red flags, you can ask smarter questions, and you can make sure you're being treated fairly. Yeah, the path can feel complex, but now you have a map. So now that you know the rules of the game, what's the first thing you're going to look for on your mortgage journey?